Okay, we now look at the counterparty risk, and in this video we are going to focus on the counterparty risk and I'll try to sensitize you to some of the very basic terms here. So you need to understand some of the terminologies that are used and how institutions can mitigate their counterparty risk and some of the definitions. So counterparty risk is the risk that a counterparty is unable or unwilling to live up to its contractual obligation within the context of derivative contracts. Default occurred at some point after the inception, but prior to the end of the contract term. If a default occurs, current and future payment required by contract will not be made. So lending risk has two characteristics. The principal amount at risk is usually known with reasonable certainty, like mortgage of fixed rate. The only part uh, uh, that takes on the risk, which is the unilateral part, counterparty risk, goes further than lending because it takes into account that the value of underlying is uncertain in terms of absolute amount, and in terms of which one of the parties will gain or lose. So counterparty risk is a bilateral agreement, and in that agreement each party takes on the risk that the counterparty will default, and the party winning takes on the risk, and the party that is losing will default. So we have to understand what are the transactions that are causing this counterparty risk, or different types of uh, places where we see these kind of risk. So the first place where we see these kind of risk is when we securitize our financing transactions like repos, reverse repo, securities, borrowing and lending. So if you're hearing this term for the first time, repo or short term agreement for 1 day or so, which is securitized by collateral. The lender receives the repo rate and the receiver receives the risk-free rate charge plus a counterparty risk charge. Collateral is usually in form of liquid securities. A haircut is applied to mitigate the counterparty risk that the borrower will not repay the cash, to mitigate against a decline in the value. To illustrate a haircut, if we assume 2% haircut on a 100 million loan amount, this means that approximately 100 or 2.4 million of securities is required as collateral, and 100 million loan uh, would be requiring around 100 or 2 million if there is a 2% haircut. So uh, if you remembered, some time ago we did talk about the prime brokerage part, and how the hedge funds kind of borrow and lend securities from the prime banker, which is an investment bank of the bank or the dealer banker. So in those kind of places they might require things for 1 day, and these are risks that comes into play. So OTC derivatives are other places, and interest rate derivatives, which are bulk of transaction, and foreign exchange and credit default swap. So beside the repo, the 1 day borrowing lending, the OTC derivatives are place where they see this thing. So when we compare interest rate swap to regular loan, counterparty risk is reduced for interest rate swap because there is no exchange of principal. The risk lies in the exchange of floating payment versus fixed cash payment. The notional of netting further reduces the counterparty risk, since only the difference between the two risks is exchanged periodically, and as soon as the counterparty defaults of the payment, there is no need for the other party to continue making payments. So foreign exchange instrument carry large counterparty risk due to the need of exchange notional amount and long maturities. Then we have the credit default swap, which carry large counterparty risk due to the wrong way risk and significant volatility, thereby increasing the probability that there will be a losing party. We'll talk about the wrong way risk. It's like your exposure increases when the credit quality decreases. So wrong way risk refers to exposure when counterparty credit quality worsens, and when credit quality worsens, the exposure increases, and this can be illustrated in a very simplified way, where a firm invests in Greece sovereign debt and wishes to protect it by purchasing the CDS from the Greek bank. Assuming the reduction is rating on Greek, the sovereign debt, the buyer of the CDS is winning. However, the ability of losing counterparty, the Greek bank, to meet is further impaired as a result of credit rating decrease. So this is one simple way to understand this wrong way risk. Then we need to understand how to mitigate the counterparty risk, and as we all know, the simplest way is netting, and each party required payment is computed then offset, so that the party owns a net amount, and the success of netting depends on the nature of the payments, and legal risk may be involved in netting. A second way to mitigate is by collateralization. Taking collateral equal to greater than notional amount of principal should theoretically eliminate all counterparty risk. However, taking collateral, there are some administrative costs involved in addition to taking liquidity risk. Collateral may have been sold at significant discount in short term, and legal risk, which is attempt to take title on the collateral, may be long and drawn on legal process. So this was again interesting, and rehypothecation, if you remember that term, in which this collateral was again rehypothecated. So this collateral keep on revolving between different prime bankers, and in this regard there is a risk, I think 1.6 times rehypothecation allowed. I don't remember the exact amount, but yes, the collateral is one way to reduce the risk here. The third way is through hedging and using credit derivatives allow an organization to reduce counterparty risk, and the fourth way is central counterparties, where which are often against other parts. So there are convenient way to centralize counterparty risk, settle transaction, reduce bilateral risk. Now there are several terminologies used here, like credit exposure, credit mitigation, recovery, mark to market, replacement cost, asymmetric exposure, and potential future. We'll quickly look at all of them. So credit exposure is the loss that is conditional on the counterparty defaulting, and it can be illustrated as a financial instrument contract between two parties. After inception, assume counterparty A is positive, its creditor is owned, its creditor and its own money. The counterparty has a negative value, it is debt and it owes money. If a counterparty B defaults, A will suffer from a loss because A has a positive value. So it's better to have a negative credit exposure, and that's the time where you don't have any counterparty risk. So in quantifying exposure, it is not always the case that full principal amount is at risk. Therefore, a more relevant calculation is replaced, and furthermore, calculation must consider current exposure, current claims, commitments. And regarding credit migration, the counterparty may default or its credit rating may deteriorate over time, especially for long-term horizon. Alternatively, there may be improvement in the credit rating. So to access credit mitigation, we should consider the term structure of default probability, and there are three things that we see here in the term structure, which are like future default probability will likely decrease over time, and especially for periods far into the future, and this is due to higher likelihood that the default will have already occurred at some point in earlier time. An expected deterioration in credit quality suggests an increasing probability over time, and an expected improvement suggests a decrease in probability of default over time. So empirically, there is mean reversion in credit quality. So the implication is that counterparty with strong credit rating tends to deteriorate, increasing default probabilities over time, and which weak rating tends to improve. So we believe that they are mean reverting. Now, something different to here, we always see that there are different models. One are like Brownian motion, one is mean reverting, and different kinds. So when we use that mean reverting, if you remember, we saw the Vazag interest rate model, which was mean reverting. So that's again the mean reverting model that you can use, and there would be different models. So recovery is measured by recovery rate, which is the proportion of outstanding claim. So for example, 70% of recovery suggests 30% of loss. So as discussed earlier in the definition of exposure, recovery is not usually considered when pricing credit risk. Related concept of recovery is loss given default, which is calculated as 1 minus recovery rate. Then we have mark to market, which is an actual accounting measure that is equal to sum of mark to market values of all contracts. Although in theory it represents the current potential, or it does not consider other factors such as netting, collateral, hedging. Mark to market equals to present value of all expected future inflows less the present value of expected payments. However, although generally close, current replacement cost is not theoretically same as mark to market due to factors such as transaction and bid-ask spread. The underlying contracts between parties are settled on mark to market basis at the time of default. Asymmetric exposure in events of default is illustrated when a party loses its MTM positive and has no gain in when MTM is negative. So there is an asymmetry here. Positive MTM represent that the claim against a defaulting party. Any recovery will help reduce default cost. Negative MTM represent no amount still legally owed to defaulting party. So the asymmetric exposure risk profile is similar to that of a short option. So in quantifying exposure, one need to consider the volatility of MTM value. A potential future exposure is an estimate of MTM at a specified point in time. It is usually based on high confidence, taking into account the worst case scenario. The current MTM may follow a number of different paths into the future. So probability of P can be derived where we can use the paths, various paths that could actually happen, and any point in those paths will have a different probability attached to it. Now the question arises how to manage these kind of risk, and the way in which you can manage these kind of risk are through trading only high quality counterparties, cross product netting, closeout, collateralization, walkaway features, diverse counterparty risk, and exchange and centralized clear housing. So when you talk about trading high quality counterparties, you need to make sure that your counterparties have AAA rating and may not be required to provide collateral. Cross product netting works with derivative transaction that can have both positive and negative value. In case of a default by either counterparty, a netting agreement will allow transaction to be aggregated and reduce risk of both parties. The legal and operation risk that a company netting must be considered. So that's where the netting becomes a little tricky. So trades with positive mark to market, trades with negative mark to market, trade with no netting, trades with netting will have a different kind of exposure. So with netting you can actually bring down everything, like if you have various trades, positive, negative exposure. So netting can help you actually count the final amount that you own. So something like that, you add all of them. Then we have the closeout, that is an immediate closing of all contract with the default counterparty. When combined with the netting mark to market value, institution may offset what it owns to counterparty, and this is again one way. Now we move to collateralization, that is margining, occurs in the form of collateral agreement, and two parties can reduce risk by providing sufficient collateral. Sufficient collateral does not theoretically reduce the net exposure to zero. Positive collateral is done on periodic basis to minimize transaction cost. However, collateralization does come with market, operational and legal risk, as well as significant work is required to ensure that the process is done properly. So this becomes a little tricky. Again, the hypothecation is a lot of controversial thing. Then we have the walkaway feature that allow party to cancel a transaction if counterparty defaults. The advantage of party is negative MTM and the counterparty default. So they can just cancel out and walk out. Diversification of counterparty risk limit credit exposure to any counterparty. So diversification is again one way. And exchanges and centralized clearing house take the role of counterparty and guarantees all trades. So that's again one way to look at things. Now AAA, too big to fail, and there are drawbacks on relying to them, because again the things might become tricky. So many parties simply assume that AAA or too big to fail resulted in minimum no counterparty risk. That proved to be devastating, because Lehman Brothers was AAA and it defaulted. So reliance on such institution is only on short term, and in terms of long term the counterparty risk exists. So many monoline insurance companies had AAA rating, and they did not have collateral. Therefore the counterparty with monoliners were false. Those AAA did not represented the real risk. So the question arises, how do we quantify this kind of risk? And so the quantifying level becomes trade level, counterparty level and portfolio level. And within the context of derivative pricing, there is a portion that assumes no counterparty risk and a portion that accounts for counterparty risk. The portion that accounts for counterparty risk is known as credit valuation adjustment. A trader's objective is to earn a return on the credit valuation adjustment. And credit valuation adjustment takes into account the default probabilities of party, counterparty, nature of transaction, netting, any existing collateralization, any existing hedging, and we can calculate the CVA. Now how to hedge this counterparty risk, and what are the factors that we need to consider in the capital requirement? So hedging counterparty risk can occur by purchasing a credit default swap for a notional amount equal to the net exposure. That will reduce the exposure to zero and allow further transaction. The CDS would also require to hedge exposure at the amounts above the credit line limit between the two counterparties. Hedging decision must be considered the ability to trade CDS on that particular counterparty as well as hedging costs. So one issue with the CDS is they might not be liquid. You need to take care of them. So tailored products such as contingent credit default swap could be used, and if counterparty A is trading with counterparty B, counterparty A is exposed to party risk of B. Counterparty A purchases CDS for counterparty C that's referenced both counterparty B and the underlying contract. At this point, A has efficiently transferred the risk of counterparty B to counterparty C, and A is only exposed if both counterparties default. So you can do these kind of things where you can manage both of them in one go. So while we look at capital requirement for counterparty risk, we need to consider unexpected losses, correlations between default of different counterparties, and capital for counterparty given the asymmetric nature of exposure. Capital can be used to provide cushion. Unexpected losses are best comprehended at portfolio level, and the correlation, a high positive correlation suggests an increase of probability of multiple defaults. So in that case, unexpected loss will increase, therefore requires greater capital allocation. Assessing capital, given the asymmetric nature of exposure further than just the correlation, so this concern is again there. So we now move to something called the credit exposure matrix. An expected market to mark to market, expected exposure, potential future exposure, expected positive exposure, effective exposure, and maximum exposure. So effective mark to market is the forward or the expected value of transaction at a given point in time in future, and the long measurement period as well, and specifics of cash flow may cause large differences between mark to market and expected. Expected exposure is the amount that is expected to be lost if counterparty default. Expected exposure is larger than expected mark to market, since the latter consider both positive and negative MTM. So this is a point. So future exposure is the worst exposure that could occur at a given time, and potential future exposure exposes a gain amount, since the amount at risk if the counterparty default. Maximum PFE is the highest PFE value at a started time. So this credit exposure has three things: expected mark to market, expected exposure, expected future exposure. So expected future exposure or potential future exposure is the worst exposure. So all of them lies different on the distribution. And expected positive exposure is the average expected exposure over time, and expected positive exposure is used as a single amount of P to quantify things. Then effective expected exposure and effective expected potential exposure, and these could be used to properly capture rollover risk for short period. And effective expected exposure is equal to non-decreasing effective exposure. So there are various exposure terms, and you need to understand how the expected exposure, the effective expected, all these exposure moves over in time. So I think that would do it for this session, and we'll meet again and talk more about the counterparty risk.